Yes.
All right. Okay, we got it. We got it. Technology. It's such a wondrous,
Success.
wonderful thing. Wonderful thing. Okay, Adam,
Excellent.
tell us what you do here at Canaccord Genuity for our clients, if you don't mind. Again.
Okay. So hopefully everybody can hear me this time. I've adjusted microphone volume. I am the wealth and estate planning specialist on the Canaccord team. I work with clients to achieve their financial goals, including retirement planning, estate planning, tax strategies, insurance, succession strategies for businesses, pretty much anything that's a financial goal for a client. We want to help you try to achieve that. I'm also as a mortgage specialist, so we'll chat about that a little bit further today.
All right. So last week, what do you think, Adam? Pretty crazy week, eh?
Last week was a bit of a crazy week. I wouldn't say just last week, but in general, the last couple of weeks have been a bit crazy. I don't know how you found it on your end there, Rob. I'm sure it's been a little bit crazy.
Yeah, I mean, I found it crazy. I mean, we were on Monday and Thursday, and the one key thing that I thought to make sure to mention today is yesterday was all in all a good week, right? Like it felt like it was so disastrous because it started Monday. We were down, I don't know how many thousand points on Monday, and then a bit of recovery on Tuesday, Wednesday, Thursday. That's an understatement. We gained 20% in those 3 days, in those 3 trading days, and then now Friday was a bit of a down day, but today's back kind of positive. So we're getting no longer days of 10% swings one way or another. Some of the indices move quite a bit. Some of the sectors move quite a bit too, Adam. And it's not the ones necessarily you would think.
Yeah. So what would you say outperformed last week and what underperformed in the most recent times?
Well, last week, so typically what happen in situations like this is you get a bit of run towards. So the ones that have been beat up the worst typically are the ones who recover the worst. So the strongest performers last week, I'm talking about last week, utilities were up 18%, industrials up 15%, real estate up 15%, energy 12%, financials 12%, consumer discretionary 12%, tech 11%. And the worst performing sectors were communication, consumer staples, and healthcare. They were all up about 8%.
So, Rob, you mentioned energy.
Yeah.
Oil's been all over the news lately about what's been happening. I keep seeing this WCS, this WTI, crude. What the heck is the difference, and what does it mean to the actual oil prices? I know I filled up at Costco and gas was super cheap, so I'm quite happy. But obviously, there's more to the story.
Yeah, how cheap was gas? Who's got the cheapest gas tank in the last week here? What would it be, like 60, 67, 69? What would be the cheapest gas?
59.9.
59.9?
Yeah.
59.9. That's like back in the day when I started dating my now wife, girlfriend. I remember paying in the 50s. Give me a cheapest. Did someone beat Adam's price for 59.9? Anyways, regardless, so crude is the price of the commodity, straight up the commodity. WTI is West Texas Intermediate. That's the price of crude out of Texas. WCS is Western Canada Select. That is crude oil leaving Western Canada, or Alberta, if you will. So today, I saw crude below Western Canada Select, WCS crude, below $3 for a portion of the day. So it's trading around anywhere between $3 and $4. That is a full-blown cataclysmic crash for oil prices in Canada. And it's pretty significant. So Western WTI traded, and I think crude both traded below $20 today for a portion of the day. So this is a steep fall. We were at 60, $70 not that long ago. Big drop in oil and gas prices, Adam. It's those stocks are getting beat up real bad.
So I know as a consumer, I'm not complaining because I pay less for fuel costs. But what does this really mean for the oil and gas sector, especially because Canada is rather reliant on that?
Yeah, so what we're seeing in the stock market is one thing, but what's going to happen with jobs and stuff is another. What we're seeing in the stock market is these companies are trading at 5-10 cents on the dollar that they were 4 months ago or even like a year ago. So these stocks are really beat up. There is going to be a point, and I don't know when that is, Adam, where these producers are going to turn off the taps and effectively stop producing oil. At this price, it's going to happen. We talked about it on Thursday. The price of oil is about a $7 to $9 cost to ship a barrel out of Western Canada. So you're getting $3 for it, and you're shipping it out at $7. The math just doesn't add up. I was talking to one of my clients and friends yesterday. He's out in that business in Saskatchewan, and he was telling me, I love asking people on the ground. He was operating at about 40% capacity, so he picks up oil and he brings it to the pipeline. He's operating at about 40% capacity right now. And I asked him, do you see a situation where they turn the taps off? And he said, maybe, not short term. He doesn't see it happening short term because they have obligations, because it's an extremely expensive process to just straight out do that. But he does think that it will happen at some point if they stay at this price. So yeah, it's not pretty out there, Adam, and that'll likely lead to job losses. I mean, if you start getting layoffs in Western Canada, and that's when Trudeau's kind of announcements, will hopefully pick that up.
So
go ahead.
Speaking about Trudeau's announcements, there's a lot of fiscal policy, monetary policy, all these things being thrown out there. A lot of stimulus, I believe, that's being thrown into the economy, both on the U.S. and the Canadian side. But you describe maybe what's going on and what the impact might have.
Okay, this can be extremely complicated, Adam. You're a smart guy, but I'm going to try to break this down as simply as I can. There's kind of three things happening. First of all, really it's two. There's stimulus, and I talked about this last week, but I just want to make sure we're on the same page with this. Stimulus is effectively pumping money into the economy. There's a bunch of different ways you can do that, but that's a government decision. It's done through either lowering taxes, paying out checks to individuals, maybe benefits for their children, tax grants, tax savings, small business tax grants, anything like that is effectively leaving money in consumers' pockets. That is fiscal stimulus. A whole bunch of different ways it can be done, but typically those are the most common. Monetary policy is what the Bank of Canada does, or the Fed in the U.S., and what they do is they manage the overall supply of money, they control the interest rates, and they try to develop strategies which will keep money as much as possible in the hands of consumers right now and spur the economy. So how do they do that? They reduce interest rates. That was the first thing they did. In fact, they did that last week. And more importantly, what we're going to see now in Canada for the first time ever, quantitative easing. Have you heard of that, Adam?
I've read about it in past studies, but I haven't paid too much attention to it otherwise.
Yeah, basically quantitative easing is extreme monetary policy where the government goes out and buys bonds or other guaranteed type investments from banks or lenders, traditionally large Canadian banks. In this case, they're going to be buying about $5 billion per week of bonds to kind of shore up the liquidity, to shore up the market. So remember last week when I talked about what happens to an illiquid market? So if there's not enough buyers, in a market, prices go down. Well, they're going to prop up that artificially by buying some assets every single week to effectively throw money into the financial markets, into the bond market, if you will. And that's a method that has never been done in Canada, and it's extremely interesting.
And you said $5 billion with a B. Now, where is all this money coming from?
They have a bottomless pit, Adam. Don't you know?
I wish I had a bottomless pit.
Yeah, I think I know what your question is. You're saying if they're going to print all this money, is this going to bite us at some point in the future? I think the answer is, so right now, this stimulus package is about, round numbers, 6% of our GDP. Remember, I talked about this last week, but I'm going to say it again. We can and have in the past gone up to about 30, even north of 30% of the GDP annually in kind of stimulus or printing money or QE in order to survive the economy. Now, that was done in the Great World Wars. But in this case, about 6% of the GDP is what they've kind of talked about. And you're right. We're going to have to pay for that, Adam. You, me, society as a whole. We're going to pay for that for the foreseeable future. And, I don't want to get into a political debate here at all. I have no interest in doing that. But, they saw it fit that it would make sense to keep money in consumers' pockets, spending, so that, the entire country doesn't go bankrupt. Who knows if that's a good move short term? I think it probably was. But, who knows what the future holds for that. Hey, Adam, I'm going to switch things up a bit. I'm going to ask you some questions. Make sure to ask your questions. I'm looking here on Facebook. We had a question come in from email. It's asking me about financial planning, and should I be panicking in a time here? Should I be making any changes to my financial plan when the markets are crashing like this?
I generally would say it's not a time to make drastic changes. It's certainly a time to look at and see, are your plans still on track? Has anything changed in your goals, your objectives? Has anything changed on your timeline? Is your retirement still on track? It's always a good thing to kind of, revisit those items and see. When we do financial planning, we being, for the most part, we use conservative assumptions, so we don't want to try to overpromise rates of return or inflation rates. We use a long life expectancy. We want to make sure that your money lasts for your lifetime. So it's certainly a good thing to revisit that. Give you the peace of mind knowing that your goals are on track, right? Often a dip can happen, potentially several times in your retirement. We want to make sure that it's not going to have a major impact on your lifestyle.
Okay, so that's for planning. And now, by the way, people are chiming in all sorts of 52 cents apparently at Costco. I wouldn't know. I'm staying as far away from my can as Costco. So if you have other prices, please let me know. Now, Adam, we talked a lot about asset allocation. So you talked about financial planning. What about retirement planning, changes to asset allocation? Is that something that you as a planner would recommend to clients in this time? Or do you kind of think about maybe just prudent rebalancing?
I'd say it's certainly a good time to have prudent rebalancing. Take some lower risk investments, potentially, re-diversify and kind of rebalance your asset allocation, take advantage of some lower price equities if that's the case. I always like seeing income generation into the investment mix as well. Are your investments producing enough income distributions on a monthly or quarterly basis that can provide you a good cash flow as well? And if you don't necessarily need that entire cash flow, well, that can be reinvested and constantly add into the pot as well.
Okay, I've got a question here online on the YouTube. Is now the time to be putting money into the stock market? It's a question we get all the time on one of these Facebook live events and YouTube live events. I'm going to address it right now, Adam, and I'll get back to some questions for you because I do want to talk about the changes that have been asked and implemented with respect to interest rates and interest payments and deferral. So I want to get to that, but I do want to address this question with respect to putting money in the stock market. I'm going to say the same thing I said last week. Our views changed a tiny bit because the markets have moved a little bit, but we believe it's prudent right now if you have cash on the sideline that can be invested for more than the short term. We believe if that money is earmarked for the market, pick a number, whatever it is, 50 grand, 100 grand, and put that in the market in a two-tiered approach. I would advise a portion now, and I would advise keep a portion powder dry in case we do see some renewed testing of the lows. We do believe, based on technical analysis and based on some macro analysis, that there will be some new retesting of the lows. And just to define that, that means the lows that we had last week on the Dow, on the S&P, on the TSX, retesting. So the Dow hit 18,000, retesting of the lows. That doesn't mean we'll hit 18,000 again, but typically when there are these crashes that are in short order, I believe if you're a client of mine today, you got a note from me comparing the 87 crash to the 2020 crash, and it's remarkably eerie to look at that chart. But anyways, there's typically a relief rally. I believe we are in the relief rally right now, and typically when further bad news comes, there's more capitulation, and typically we see a retesting of the low. So if you want to invest in the market, I absolutely unequivocally think it's a good idea if it makes sense for you in your asset allocation, your risk tolerance. You should be buying quality with that. I would advise not to speculate. There are some really good companies that are playing a high yield, extremely safe companies. You're going to make your yield, plus you're going to make capital appreciation. To answer your question, yes, sometimes they do call it the dead cat bounce. Although this is not a dead cat. Our stock market is not a dead cat. Adam, I got a question here online with respect to, this is a question I've been getting a lot, and I got a few people email me this. Tell me about the mortgage deferral options. By the way, everyone, before I get too far, Adam is also a mortgage broker, certified mortgage broker with Castle Mortgage Group, and he helps our clients as well with all their lending needs, whether it's mortgages or other lending needs, I guess I could say. And tell me about what you've seen on the mortgage deferral options in your space.
Well, this is constantly evolving, and most of the lenders are rapidly trying to put out different solutions in place for their clients to make sure that they're not facing unnecessary financial burdens. So most lenders out there are allowing up to 6 months of mortgage payment deferral. So in that time period, they don't have to worry about making those mortgage payments, especially if you've been affected by reduced employment or income as a result of COVID-19. However, things that people don't often look at, or sometimes they question, is will this affect my credit rating long term? The answer is it's not supposed to affect your credit rating long term. However, this is an unprecedented situation. We haven't come across this necessarily before, where banks are offering 6 months of payment deferrals on the mortgage. But then we want to ask, what happens to all that interest? The bank isn't turning off the interest calculator behind the scenes. You're still getting charged your 2, 3, 4% interest rate on your mortgage throughout the entire 6 months of the interest. The bank isn't turning off the interest calculator behind the scenes is eventually going to have to be paid, whether it gets tacked onto the mortgage, increase your amortization. Your next 6 months to a year of payments afterwards might be interest only, just to kind of catch up from that interest that's due behind the scenes.
Okay. Now, you talked about deferrals. Let's talk about let's talk about that. The Global asked me this. Global News asked me this. The actual deferrals. So you're for sure not going interest free, right?
It's not interest free. You're still going to have to pay interest at some point. It is still accumulating behind the scenes. Most people, if you look at your mortgage payments today, ballpark, half of it is interest and half of it is principal.
So do you see them just kind of effectively shuffling the payments down the line, or do they spread them out over the life of the mortgage?
I'm thinking that at the next time that they have to renew the term, whatever interest is still accrued behind the scenes might get added as a lump sum on refinance. It might just be all your next payments, once you start making your payments again, are going to be solid interest until all of that back interest is caught up on, which could mean another 6 months of mortgage payments might only be interest and not paying down the mortgage whatsoever. Again, this is new. A lot of lenders haven't rolled out all the fine details quite yet. They're trying to make sure that their clients are looked after and not causing behind the scenes. Most people, if you look at your mortgage payments today, ballpark, half of it is interest and half of it.
So let me ask you real quick about interest rates, because this week we finally saw, well, I shouldn't say finally, on Friday last week we saw, was that the third rate cut, Adam? We did 50.
The third rate cut. Bank of Canada has dropped rates by 0.5% 3 times in unexpected rate announcements, not the set quarterly rate reviews.
Yeah, so typically how they do this is they'll have monthly meetings. They don't meet in the summer. They're like lawyers. No, I'm kidding. But they're like litigators, let's say that. Although I was talking to a litigator today, and he was telling me that they're gearing up for like litigation season to take them through the summer, which is kind of odd because I used to be a litigator. That's what I used to do in my career. I used to practice law, and I used to. The neat thing about being a litigator is in the summer months the courts are closed, so you didn't have to worry about it. But anyways, who knows what will happen there? Typically, the Bank of Canada meets every month except in the summer, and they announce interest rates at predetermined dates, predetermined meetings. You just mentioned 3 times in the last month that they've announced 50-point cuts. We are now at 25 basis points, 0.25%. You guys may recall that on Thursday I had a question about interest rates. And I said we are likely to see negative rates in Canada before we're going to see the story of 3, 4, 5% overnight rates in my mind. And lo and behold, the next day they cut rates 50 basis points. Again, I'm not a clairvoyant by any stretch, but I just felt like that had to come. So what did they actually do? So they did 3 cuts, 50%, 50 beeps. And now the overnight rate is at a quarter point.
Quarter
point. I want to ask you about the prime rates for the banks. This is a question that's coming online here from Peter. He's asking about how come the posted prime rate is still 3.95.
So every lender sets their own prime rate. They don't necessarily have to follow what the Bank of Canada is doing. Some lenders have dropped their prime to 2.45. Some have dropped it to 2.95. Every lender is a little bit different on that one. Some have dropped their prime rate but reduced the discounts they used to offer off prime. Some lenders used to offer a variable at prime minus 1%. Now it's maybe just prime and there's no minus attached to it. So a lot of the banks are reacting differently, and I think they're still trying to figure out where things are going to be going. Yeah, especially when it comes to the fixed rate markets. A lot of them dropped initially when the rates changed, and then subsequently have actually increased their rates higher than what it was before all the rate changes. So I think it's maybe some added risk in the marketplace. Maybe they're worried about bankruptcies or unemployment, so they have kind of adjusted their overall pricing for risk. But they are changing literally daily. So we're constantly keeping up to date as to what's changing on the rates and making sure that we get our clients the best overall mortgage offer.
Yeah, I think a wise person once said, here's a situation where you want to own the banks, right? Because interest rates have moved and their spread has not moved. So typically banks make a profit on the spread. So the money that is being placed in the bank in term deposits, the spread of that versus money that they're lending out. There's a comment here, a couple of our commenters, Marilyn and Peter, are saying the big six are taking, their costs went down and they're taking the difference and they're screwing us, is what he's saying. I certainly am not going to comment on that, but on its face, it appears that 150 basis point movement in one way and the rate's not moving. You would almost have to believe that that is due to their perception of a higher default rate, I would imagine, Adam.
Yeah, I assume they actually lowered their savings rates on all the products, but they haven't necessarily dropped all their mortgage rates. So yes, I'm assuming it's mostly for default risk as to why they've adjusted it. But it is constantly changing. The last 0.5% drop is quite fresh. So a lot of lenders out there haven't necessarily reacted to it quite yet. So we're kind of waiting and seeing as to what's going to happen.
Okay, I want to ask you about you and I, we can sometimes put our thinking caps on and try to figure out what the next step might be for the Bank of Canada. I mean, I know it's been tough to predict. So they're now at a quarter point, and Governor Stephen Pelosi said that the effective lower bound is now a quarter point, but conceded that theoretically the overnight rate could be lowered to minus 0.5 point. This was in a comment that was made on Friday, I believe. He also added that given the lack of success that negative rates have had, the Bank of Canada is not contemplating negative rates yet, although they're out of options, they're out of ammo, right? They do not have any bullets left in that stimulus gun, if you will, to lower rates any further, but they do remain in the toolkit. So do you think, I mean, this is purely speculative, but I mean, for me, I think the next steps are likely to be more stimulus in the forms of cash back in the hands of consumers and less monetary policy adjustments to the interest rates. Would you agree with that?
I personally can't see that further interest changes would have much effect on the overall economy. I mean, you see that most lenders don't even adjust their rates when the Bank of Canada has dropped them so suddenly. So if the Bank of Canada changes rates further, is that really going to have an impact as to what everybody's actually doing in the marketplace? Again, I'm not an economist, but that would just be my opinion.
No, but you know what? You're on my show here, Adam, today, so you can opine.
I can say whatever I want then, right?
Well, no, let's remember compliance, Adam. Let's remember compliance.
Okay.
Anyways, I do think that they're effectively, if the idea was to leave more dollars in consumers' pockets by reducing the interest rates, I mean, I know there's more than that. I know there's the idea that companies and corporations and they have less expenses. But if that's the idea and the banks didn't move their rates, that's a bit of a backfire, right? Because then the end consumer does not have more dollars in his pocket, which is why I think the next steps will likely be, either more quantitative easing, so more purchasing of bonds, more purchasing of bank bonds, and they do this by a reverse auction. And if you want me to get really complicated and lose all of you real quick, I could explain a reverse auction, but I won't. Or they might just do, just a reduced rates for increased liquidity in the overnight market. I don't know, but I think that is coming, and I think that we're going to find out a lot more in the near future. What do we know about that? They announced that there's still details to be coming yet about Trudeau's stimulus package, right? The 75% up to 55,000 or something. What's the latest on that? Do we know what's going on there, Adam?
I haven't necessarily heard the latest on that one.
Yeah.
I was looking online this morning to see when the budget was going to come out, and that's been pushed back, I think, till April sometime when the cabinet can meet again. But yeah, there's constantly new programs and new information getting rolled out. So it's good to keep up to date as to all the changes, and they are changing very frequently.
And we'll make sure to update you guys here. So stay tuned to. We're gonna have to think of a name for the show, Adam. I don't know. The investment guy talks. But by the way, do you guys have names? Interesting names? Ideas for names for this show? Twice a week, Mondays and Thursdays, 3 p.m. after the market close. I'm gonna take you guys. I'm gonna walk you guys through this crash over the next month, 2 months, 3 months, whatever it takes. If you guys have an idea for the name of the show, remember, I like to be clever and I like to be funny. So I'm typically not funny, but at least I like to have funny ideas, and I could steal funny ideas from other people. So if you have an idea for the name of the show, please make sure to share with us. There's a question that came on here about about insurance coverage, Adam. You're also insurance licensed. I'm insurance licensed. I've noticed a ton of people in the last week or two have been asking me about insurance coverage. I'm guessing that's partly, this COVID is kind of reminding us all that, we're not going to be here forever. What about, first of all, your thoughts on that, Adam? Second of all, your thoughts on group policies and people that are either laid off or not working? Maybe start with the first part. So, tell me about the first part. Sorry.
I'll start with the first part. Certainly, I mean, when things like this happen in the world, or if there's any health impacts within a family itself, that often spurs the need for reviewing somebody's insurance, determine if they have enough coverage and if they have the right type of coverage in place. Also, people are maybe working from home or have some additional time off work and actually have time to look at these things that maybe have been on the back burner for a little while, and maybe not the most exciting topic for most people, but it's certainly important to look at. As for the group insurance side of things, if your employment is in question, if you've lost your employment or had to cut back, maybe you've lost some group benefits, maybe your only insurance coverage was the group insurance coverage that was provided from your employer. So if that employment is lost, now what happens to that insurance coverage? I'm certainly a believer of having the bulk of your insurance coverage as a policy that you own, that you control. So if you change employer or if you change lending institution, you own the policy. It's not going to change on you. You have full control on it.
Much like a policy on mortgage insurance, I would imagine.
Exactly. I mean, if you want to change from one lender to another lender, you have to reapply for that coverage. Or if you want to refinance and add more money to the mortgage, well, now you got to refinance. You got to change the insurance policy and requalify based on current health conditions. If you had a policy that you own directly, the coverage is not going to go down every single time you make a mortgage payment. The coverage is going to be level. So you're certainly getting a lot better bang for your buck on the insurance side of things. Plus, you own the policy, right?
Yeah, there's a lot of chatter here online about the banks taking the spread, and I guess that spurred some commentary here on the YouTube page. But the banks did lower their rates, like that's happening. They lowered their rate, and they've not reduced the rate that we are borrowing at. So their spread effectively got larger. So people are asking me to explain that. It's as simple as it could be. The spread has not been borne by the banks at this point, or in fact, the spread has increased at this point, is what we're seeing. Who knows? That might change in the future, but for now, that's what we're seeing, likely due to increased likelihood of defaults. Adam, I want to ask you about some other anything other on the on the insurance side, that discussion that's come up in the last month or so that didn't used to come up, now that people are thinking about this?
I can't necessarily say there's anything else exciting. I mean, certainly a good time to look at whole life insurance policies, as part of a diversification tool for maybe a non-registered investment portfolio as a sleeve perhaps of your fixed income component. All kinds of neat and interesting things that we can do on the insurance front. As exciting as insurance itself can get, there's certainly a lot that we can look at and stuff that we want to make sure that we look at on the planning side of things for clients.
Okay. Adam, I'm going to just take you guys through a bit of last week and some year-to-date numbers as well here. So as a reminder, I'm Rob Tetrault, robtetrault.com. I'm here live with Adam Buss. We're both at Canaccord Genuity Wealth Management. Adam is also a mortgage specialist at Castle Mortgage Group. You know what they do on radio? I don't know if you guys ever watch the radio. If they're doing an interview, they always kind of come back and they remind the viewers, the listeners, what the score is, who they're talking to, who they're on. That's what I just did. I'm trying to be a pro here. If you guys want to have any idea how much we're down year to date, this is as Friday close. As of Friday close, we were down year to date on energy. We're down 41%, 31 in consumers, 36 in healthcare. The ones that weren't down as much year to date in Canada, IT, utilities, and materials. Those are the three sectors that are down about 10% or less. The ones that are the most beat up are healthcare, energy, and consumer discretionary. So now weekly, the ones that are down the most typically move the most as well, right? On the commodity front, crude oil is obviously down the most. It's down, year to date, it's down 64%. Natural gas down 25, silver's down 18, copper's down 22, lumber's down 26. Lumber obviously is as a result of, people maybe putting their expansion projects on hold, I would imagine. And then gold is up about 8% year to date. We had talked, Adam, about, or I guess we hadn't talked, but we have talked on the show about, what sectors we think might bounce back, what sectors might have the best benefit on a go forward. And I've asked some people to ask me to make predictions. So one thing we're not going to do is make predictions. And another thing we're not going to do on this show is discuss, what's actually happening day to day, week to week with respect to infections or cures or anything. However, someone asked me, sent me a note online about these pharmaceutical companies that are hitting all-time highs or they're rallying quite a bit. And most of these are on the heels of announcements that they are working on a virus. So there's a question here asking me about, I'm not going to mention the specific stock, but some stocks that are working on vaccines or that have announced treatment for COVID. And those guys are rallying. Should I buy those stocks is the question. I would just caution you, if you are buying those stocks, typically you're doing the reverse. Typically the market is wrong on these purchases. I hate to tell you guys this. Typically the market is wrong. The stuff that is being sold is typically the stuff that you want to be buying, and the stuff that is being bought is typically where you want to go last. So if you're buying into stocks that are hitting all-time highs right now, you really have to ask yourself, do you know more than the market? And are we going to get to the point where these stocks are going to go back? They're going to regress to the mean, and they're going to go back to the valuation that they had before COVID happened. And if that is the case, you're going to have lost in two ways. One, you're going to have bought a stock at a high that has fallen. And two, you're going to have missed out buying a stock like a financial company or anything that is 30, 35% down that has rallied. So I'd be very cautious about that. Make sure to talk to your advisor. To me, that is a risky trade. That is a risky trade to go and buy a high flyer, small cap, pharmaceutical company that's working on a vaccine or working on a cure for COVID. I would much rather buy something that's corrected 30, 40%. That's quality that you think will pick back up. Question here.
So Rob,
yeah.
Just talking about the volatility. What is this VIX I hear about, and how does that relate to what we might see in the market?
Yes. So the VIX is the volatility index for short. The volatility index is how much in this case, the markets, so the American markets, are moving on a day-to-day, week-to-week, month-to-month basis, and it's measured live. So it uses derivatives, so how much change in the curve of the different stocks. So both positive and negative are changes to the slope of the curve. If you remember math, if you took some advanced math courses in university, you would have taken a look at derivatives and second derivatives, so change of change, if you will, and it measures that. it measures on a number. So the highest we've ever seen, we hit the highest VIX, I want to say ever, last week or the week before. It was close to 90, 95, 85, somewhere around there. 90, I want to say, on the VIX. Even in 08, we didn't hit 90. The difference between now and 08 is that we had a crazy immediate spike, which is a large change in minute to minute, hour to hour volatility, which is reflected in the VIX. So the VIX is basically volatility. How much are stocks moving on a day-to-day basis? I checked it earlier today. It was in the 40s, which normally would be really, really high. But right now, relative to the numbers we saw, remember, Adam, when every day you and I would sit down and we'd have a 10% swing one way or another, 1,000 points this way, 1,000 points the other way. Well, at least it feels like we're somewhat out of that for now. We've had 3 or 4 consecutive days now where the markets are not moving 1,000 points. So, that's positive for the VIX. The VIX falls to 40. It measures volatility. Additionally, if you're trading options, and I'm not thinking you are, but if you are trading options, there's the more volatile, the more your options are going to cost you, and the more you're likely going to see on a spread on options. Now, I don't think we're talking about options today, but that's something to be extremely careful about. I'm just looking at some more comments here online asking about spread. Some ideas for our show: how not to crash with Rob. How not to crash with Rob and friends. I like that. How not to crash. That's not bad, Christine. Thanks for that. The Canadian Pros Show. That's not bad. We could kind of make a word on a play on that. One investment guy talking to a camera. That's not bad. It's not a bad name. I don't really like that one as much. Let's go on to here another question here. There's a question about spread and day trading. There's a question here about day trading. Peter, I respectfully disagree. I appreciate your comments, but I respectfully disagree. The only way to play those types of stocks are day trading. Ask me about day trading. Listen, if you're at home and you're doing this on your own and you're trying to day trade, good on you. It's not for the weak of heart. It's not for the faint of heart. What happens with day trading is you're going to make money most of the time in up markets because historically stocks go up. You're going to sell something, you're going to buy something, you're going to set another target, it'll hit that target, and you just keep doing that. What happens is in a mass panic sell-off like the one we saw, everyone loses. All your positions end up losing. So as much as you think your technical skills are better than anyone else, I would advise against it. That's my professional opinion. I respect that some people want to try it. You're going to get cleaned up because right now, it's impossible to know if the stocks are going to be up or down in a minute or 2 or 5. Short term is the only thing we don't know. Short term is the only thing that we don't know what will happen. Medium term, I know roughly where these stocks are going to trade at, and long term, I know roughly where these stocks are going to trade at. But medium term, we don't know. Therefore, you agreeing to trade on a day-to-day, week-to-day, or minute-to-minute, or hour-to-hour is extremely imprudent, I would say, and I would certainly advise against it, to answer your question. Question about FOMO. Adam, please describe to our wonderful viewers what FOMO is. I heard my dad say it the other day for the first time.
I'm surprised that Claude knew what that was.
Yeah,
fear of missing out, right? So
yeah.
The fear of missing out, that you're going to miss that fantastic opportunity in the market. And again, that is a bit of timing. I would think that that's generally when people are buying in at the wrong time. They're buying on the peak because they're afraid of keep missing the upside of things.
Yeah, and we talked about this last week. The FOMO factor was the Tuesday, Wednesday, Thursday rally. So on Monday, I was on the show a week ago today, and I said there will be a time where people are going to start buying, and you're going to see a move. 10%, 12% in a day is not out of, it's not out of the ordinary in these crazy market crashes. Positive movements. The best days in the history ever of the stock market have always happened during periods of intense downward pressure. Intense stock market crashes, they breed positive gains because what happens is the FOMO factor happens. On Tuesday, up 12%. People see the evening news. They were out of the market. Maybe they sold everything. And then on Wednesday, they see, I want to be part of that. I want to invest. I don't want to miss the party. So they start buying, and that starts your relief rally. The FOMO factor is one that is incredibly important to consider if you're trying to day trade and if you're trying to be in and out of the market. So instead of being in and out of the market, to answer a question that we had earlier, instead of doing that, we would advise either prudent rebalancing, where you are selling assets that have kept their value. You're selling either a bond or you're selling an alternative, and you are replacing it with an asset that has fallen quite a bit. So you get to sell $1 and you get to buy something that's 70 cents. Now that is prudent rebalancing to me, and that is much, much better than day trading or trying to time the market. And then you don't have to deal with the FOMO factor, Adam. You could be FOMO free. FOMO
So
free.
that comes down to FOMO free. So that comes down to time in the market versus timing the market, correct?
Bingo. Bingo.
There we go.
Nice. That's a great segue, Adam. I will say this: us here at the Tetrault Group, we will not. All right, we will not park your money and let it sit and hope for the best. That is not what we do. All right, we are extremely. We're here every day. We have conversations every single day. I'm pounding my table right now. If Johnny Mox were here, he'd be like, "Do not pound the table, Rob. The camera shakes." But I will figuratively pound the table. We are here. We are active. We're on the phone every single day. We are rebalancing. We are making trades. We're taking advantage of assets that have kept their value. We are not the guys and gals that are going to be sitting on the sideline talking to you in 6 months and a year and saying, "Huh, there you go. It came back." No, we want to take advantage of these unprecedented generational opportunities to take advantage of prices that have corrected a ton. That is why you guys are paying us, right? You have an advisor. You're dealing with an advisor. We are going to take care of you during this time. We're going to make trades. We're looking at it every day, and we want to take advantage of that for you. I'd be an extreme hypocrite if I've been saying for the last year. So I've been saying for 1 year on BNN, on my shows, to anyone who would listen to me in my client meetings, you, Adam, I've been saying it's time to be defensive. The stock market is starting to get stretched. I've been saying that for over a year now. Well, how much of a hypocrite would I be if we called that right and then we didn't act on it when the market corrected, right? So we are active managers. We are a portfolio management team here, and that's what we're going to do. We are not going to leave you high and dry, clients. So you can rest assured that we're working for you for that. And there will be no FOMO factor. You guys are going to be FOMO free if you deal with us. Got another comment here for our TV show, Rob's Market Mastery. I like it. It's alliterative. It's alliterative. Let's see if we have another question here. Do you feel strongly that we will see another big leg down to form the W recovery? I've mentioned this before. I'm going to mention it again. We believe we are in phase 2 of 3. We believe we're in the relief phase of the crash. The first phase is the panic sell, where the market falls dramatically. The second phase is the relief recovery, where you start to see one big day or 2 big or 3 big days, and then a sideways period for a while. And then you typically retest those lows with what we call either, desperation or capitulation, or the bottom, if you will, which we don't believe we've gotten to yet. So to answer your question, if we have alternatives or something that we can sell and we believe makes sense, we might sell that and pick up something here on the bottom. And the other thing that has happened over the last month, my clients, hats off to them. They're incredibly smart and incredibly sophisticated. They've been calling me, "Rob, I got some savings. Rob, I got 5, 10, 50 grand. Rob, I got 100 grand. Put this to work, put this to work." And what we are doing with that money, we are legging it in. So we're legging it in. We tried to leg in about, a third to a half, depending. In the last week or two, we tried to leg in a portion. So leg in means kind of feathering it into the market. So we're buying as the market falls. And we want to have some powder dry to be able to buy if and when we do see the capitulation. If we don't see a capitulation, if we see a sideways period for an extended period of time, we will feather that last piece of cash into the market here as the market is moving. And again, that's why you're paying us to do our job, right? So hopefully that answers your question. That was Bob, I think, who asked that question. Bob's asking a lot of questions today. Bob's in a good mood. Bob says that the VIX needs to be back to 12 before we're back to a sort of normal. Adam, before we wrap up here, just in about 5 minutes, I just want to thank you for taking the time, and I do want to mention If there's anything else that you would like to add with respect to planning, so some of the stuff you do, estate planning, insurance planning, we talked about that, mortgage lending, you talked about that, and you do this for our clients. So guys, if you are a client, you don't have to write a check or send a separate payment to Adam. It's included as part of your services with the Tetrault Wealth Advisory Group here at Canaccord Genuity Wealth Management. So Adam, you're a pleasure to work with. I'm so glad that you're on our team. Our clients benefit from having you immensely. Hats off to you. Thanks for joining us today from the, what is that, Esplanade de L, the Provencher Bridge?
Yeah, that's correct. From the comfort of my own home. Yes.
You're
Thanks for
actually
having me, Rob.
you're on your own. You're in your
I
own home.
know. Yeah, it's tricky technology. But thanks for having me, Rob. It's great to join the show that's to be named in the future, but the Rob Tetrault Show live at the moment. So thanks for having me. I hope to come back at some point in the future again.
And if you're a client and you'd like to review your plan or anything with Adam or with me, please reach out to us. We're happy to walk you through it and how you are likely not that impacted by this COVID crisis. Guys, thanks so much for tuning in. A reminder, my views here are not, I don't know what you guys own. My views are not those of Canaccord. They're those of me personally. Do not take this as investment advice. I'm not giving you investment advice. I don't know your personal situation. If you're a client, come see us. We're happy to chat about that. If you're not a client and you want us to review, please go to www.speaktorob.com. Book a no obligation consultation. We'd love to hear from you. Subscribe to the YouTube channel. Please subscribe to the channel. We put out a ton of content, and we'd love for you to be a subscribee, I guess. Thanks, everyone, for tuning in today, and we will see you Thursday at 3 p.m. from the Yet to Be Named show. Thanks, guys.